Welcome to another episode of Economics 101 here at Rebel Economics. Today, we will ask the question of exactly what is capitalism. Is it a market philosophy designed to spread wealth, to keep it in the hands of the rich and powerful, or something in between? If you're enjoying these videos, subscribe for more to Rebel Economics. Ready? Then let's start with a definition. I love this definition from the magazine of The Economist. Capitalism is the winner, at least for now, of the battle of economic isms. Capitalism is a free market system built on private ownership, in particular the idea that the owners of capital have property rights that entitle them to earn a profit as a reward for putting their capital at risk in some form of economic activity. How capitalism is actually implemented in a country varies widely, and countries can generally be put in a scale that determines how much influence the state has in regulating the standard functioning of capital to earn profits. For example, the United States is a country known to adopt a more hands-off approach to the goings-on of the economy, meaning that the US does not always favor great taxes on wealth to redistribute the money in society, but also provides comparatively lower state finance protections to its citizens than, say, the EU, who does the opposite. Both these regions are considered capitalist, by definition, but the term is so elastic as to accommodate them both. The owners of means of productions in a capitalist system are called capitalists. And while in the early years of this philosophy this term was used to embody big factory owners that literally own the means of producing things, nowadays the term is much wider. By its most basic definition, probably anyone that owns any asset is a capitalist. An asset hereby is any piece of knowledge, item, or property that can generate profits, meaning that essentially anyone is a capitalist. Do you own a house? Then you're a capitalist. Do you own stocks? Then you are a capitalist. And so on. Capitalism is therefore the method that marries private property with the right to rent out that private property to others that need it and derive profit from it. By some measures, even the workers are little capitalists because they own the means of production in some cases, meaning their bodies or their minds, and rent them out to companies who have a need of them for a profit in the form of a salary. Obviously, saying that workers are capitalists is a bit controversial, since back in the 1800s, one bearded man wrote a book that criticized the capitalist system and made a clear distinction between the big capitalists on one side, that owned factories, and the little capitalists that were the oppressed proletariat. But by the most basic definition of the term capital, we all have some of it. And we all like to get paid to rent it out, so we're all capitalists. The counterbalance to the profits obtained in capitalism by the capitalists renting out or otherwise exploiting their capital is risk. Risk is danger that the economic activity that turns capital into profits turns out not generating those profits. For example, buying a stock and it collapsing is a risk that capitalists with cash accept when they change their liquid cash for a stock that might bring them more money in the future, but also might not. So, that was it, a basic explanation of capitalism. I hope you enjoyed it. So remember to subscribe, hit the bell, let us know all the ways that you disagree with our definition in the comments, and check out some of our other videos right now.